This video takes a look at basic capital budgeting techniques. We're going to take a look at the net present value technique for evaluating a capital budgeting decision and also calculating a project's internal rate of return, or IRR. Typical capital budgeting decisions involve evaluating plant expansions, evaluating whether or not we should buy new equipment, and if so, which equipment should we select? Should we replace equipment that we currently have? Should we, if we do replace equipment or buy new equipment, should we lease the equipment or should we purchase it outright? Should we spend money on new equipment to reduce current operating costs? These would all be typical capital budgeting decisions. They're long-term decisions that involve typically 1, 5, 10, 15, 20 years. Capital budgeting tends to fall into two broad categories. The first category would be what we call screening decision. Does a project meet some preset standard or criteria? Is it an acceptable project or is it unacceptable? And then the second is a preference decision. Assuming a project is acceptable, let's say we have several different alternatives, which one should we select? Again, our two primary techniques for evaluating capital budgeting projects are our net present value technique and our internal rate of return. We're going to begin by taking a look at our net present value technique. To calculate a project's net present value, the first thing we do is we need to calculate the present value of the project's operating cash flows. The second thing we do then is we compare the present value of a project's operating cash flows with the project's initial cost or initial outlay at time zero. And the difference between the two, the net present value, is simply our present value minus our cost. And again, that cost will be all initial cash outflows at time zero. It could be the cost of the equipment and also perhaps an investment in working capital that we make at time zero or when we first start the project. In terms of evaluating projects, if a project has a positive net present value, the decision rule is accept the project. If a project has a net present value that's exactly equal to zero, we will also accept the project because we'll find later on that this project exactly meets our required rate of return. So it doesn't have anything above our required rate of return, but it meets our minimum acceptable criteria. And then finally, of course, we're going to find that if a project has a negative net present value, we would reject the project or not undertake the project. Let's go ahead and take a look at some examples. In taking a look at our capital budgeting, we're first going to evaluate the present value, see how it relates to something we've already studied, which is a bond. Recall our bond had annual cash flows, which we referred to as the coupon, and also at the bond's maturity, we received its face value or par value. Let's go ahead and use our financial calculator inputs to find our present value of our bond. Again, we're going to enter 6 for the number of years because that's when our bond matures. The bond's annual annuity payment is $50 a year. That's the bond's coupon. The $1,000 face value or par value. And if we required a 7% return on this bond, we could solve for the price and we would find the bond has a present value of $905. Now, in deciding whether or not we want to buy the bond, we would want to compare its present value, its $905 value, present value, with the bond's cost or the bond's price. If the bond was currently selling for $1,000, in other words, that was its market price, and we've determined that we require a 7% return, therefore it's only worth $905 for us, we wouldn't want to buy the bond because it would have a negative value of $95. On the other hand, if the bond was selling today for $900, we would want to buy the bond because based on our 7% required rate of return, we think the bond is worth $905. And by paying $900 for something that's worth $905, we would increase our worth by $5. At a bond price of $905, we would also buy the bond because at that price, we would exactly earn our 7% required rate of return, or our 7% yield to maturity is what we call it when we were dealing with bonds. Let's go ahead now and take a look at a capital budgeting decision or project with similar cash flows. Here's our capital budgeting project, and we're going to assume it has the same cash flows as our bond. However, now that $50 a year, instead of being a coupon, it's going to be referred to as an operating cash flow. The $1,000 face value or par value when we're talking about a bond, if the cash flow happens at the end of a capital budgeting project, we typically say it's our after-tax salvage value or perhaps the project's terminal cash flow, and that would include both an after-tax salvage and any return of net working capital, and we'll look at that more later. Let's go ahead now and calculate the present value of this particular project. We've got a 6-year project life. Our annual operating cash flow or payment is $50. Our project had a $1,000 after-tax salvage or terminal cash flow. And if we required a 7% return on our investment, we would say the project has a present value of $905. Now recall, in capital budgeting, we want to calculate our net present value. And our net present value is simply the present value of the project minus its initial cost. In this case, we found a present value of $905. And if the project cost $1,000, we would say the project has a negative $95 net present value. And of course, we would reject the project. On the other hand, if the project only cost $1,000 or $900, we would say the project has a $5 positive net present value, and we would accept the project. Likewise, we would also accept the project if it cost $905 because its present value exactly equals its cost. It has a net present value of 0, which means we are earning our 7% minimum required rate of return. So again, for our net present value, if we have a positive net present value or a net present value of 0, we will accept the project, and a negative net present value, we reject the project. Let's move on now to our internal rate of return. The internal rate of return is the discount rate that results in a project having a net present value of exactly 0. In other words, the present value of the project cash inflows minus the project's initial cost is 0. We would say the present value equals our project's cost or initial outlay at time 0. In terms of decision rules, our decision rules are as follows. If a project has an internal rate of return greater than our required rate of return, which in this case is indicated by the R, we would accept the project. If the internal rate of return exactly equals our required rate of return, we would accept the project. However, if the internal rate of return for the project is less than our required rate of return, we would reject the project. Let's take a look at several examples. Recall for our project we looked at earlier, if the project had a $905 cost, then the present value of the cash flows exactly equaled the cost, and we had a net present value of 0. And recall, the net present value of 0, that's our definition of the rate of return that gives us our project's internal rate of return. So to solve for our internal rate of return, we would have indicated or entered into the present value field or financial calculator the project cost, which we said was $905. And we would solve for the interest rate or IRR. And again, for our bond, this was simply our yield to maturity, but in this case, for capital budgeting, we would say it's its internal rate of return. So our internal rate of return for this project, if it cost $905, would be 7%. On the other hand, let's go ahead and take a look at what the internal rate of return would be if the project cost $1,000. If our project cost $1,000 and we want to find the internal rate of return, we need to find the rate that makes our net present value equal to 0. And our net present value will be equal to 0 when our present value of our project is $1,000. So what interest rate will give us a $1,000 present value? Well, we enter in our $50 a year annual operating cash flow, our $1,000 terminal cash flow or after-tax salvage, our $1,000 present value or project cost, and we solve for the interest rate and find that at a $1,000 cost, this project would provide a 5% internal rate of return. And again, This is simply the yield to maturity for our bond. Now, if we have a required rate of return of 8%, 9%, 10%, or even 6%, we would reject this project because we don't earn enough. It doesn't meet our minimum required rate of return. Now let's go back and consider what was our internal rate of return if the project cost $900. So again, if our project cost $900, we want to find the interest rate that gives us a net present value of 0, because that's our internal rate of return. To get a net present value of 0, we would say the project's present value should be $900. So we will enter in 900 as the present value of our project's cash flows. We'll enter the $50 a year for our annual operating cash flows, the $1,000 after-tax salvage or terminal cash flow, and we would solve for the interest rate, and we would find our project has a 7.1% internal rate of return. And again, if our required rate of return is 9 or 10%, we would reject this because it's lower than our required rate of return. But in this case, if our required rate of return was only 7%, our internal rate of return of 7.1 is greater, and we would accept the project. And notice, if we did have a 7% required rate of return, at any price $905 or below, we would find we have a internal rate of return greater than or equal to 7%. We would accept it, but at any project cost greater than $905, we're going to find we have an internal rate of return less than 7%, as well as a negative net present value, and we would reject the project. So again, our IRR and net present value compared. If our net present value is positive, that means our IRR is going to be greater than our required rate of return. We'll accept it. If our net present value is 0, our IRR will equal our required rate of return and we'll accept the project. And if our net present value is negative, that means the internal rate of return will be less than our required rate of return and we will reject the project. The next question we're going to look at is what discount rate, or what is it that we'll choose for our required rate of return? Our cost of capital is the average rate of return that a company is going to have to pay its long-term investors. That can be creditors or stockholders for the use of funds. The company's cost of capital is regarded typically as our minimum required rate of return. And if we have low-risk projects, we're going to have a low required rate of return. And if we have a high-risk company or high-risk project, we're typically going to have a high cost of capital or required rate of return. So again, our weighted average cost of capital is simply an average of what we're paying our bondholders and our longer-term stockholders. A few other things to keep in mind regarding our net present value method. The net present value method emphasizes cash flows and not accounting net income or GAAP income. That's because accounting net income is based on accruals that often ignore the timing of cash inflows and out of an organization. Recall, if we make a sale on credit, we don't collect any cash, but we will report a revenue which increases our net income. Likewise, depreciation expense will decrease our net income, but doesn't involve a cash outflow. Also, there are two simplifying assumptions that are typically made in our net present value analysis. The first is that all cash flows, other than that initial investment or initial outflow, incur at the end of a year or end of the period, and then also any cash flows that are generated by the project are reinvested immediately at that required rate of return or discount rate. The second assumption here is not one that you really need to pay attention to or actively do anything about, but it is an implicit assumption, and as you read through the book and study later, one of the challenges or failures or deficiencies of our internal rate of return.